So I tell them it's a natural tendency. It is an illogical thing. And here's what I ask people to do. So it's like, okay, go back and look at your passive investments. Maybe you got some, maybe you bought, a single family rental, maybe you bought something like that. And tell me what you think was your net return from those single families in the last couple of years. And people give me a number. And I say, okay, I'm going to bet you $10, $100 if you want to, that your returns are 50% lower than what you just projected to me. Okay. And people constantly come back to me and say, hey, I did the math and you were right. How did you know that these returns were lower? The answer is when people make their own investments, right? They're in charge. So they're not feeling that pressure from their investors. So they just accept whatever returns they get. They accept that this is okay. They accept that this is the way it's meant to be. And no investor that I know, including myself, I'm pretty anal, actually tracks their single families on a monthly basis, actually tracks their stocks on a monthly basis. And I would argue that if you actually don't track on a weekly basis, you're missing out on lots of profit. You're going to fall further behind market. You're not going to optimize. And so when I look at what people are making on their own portfolio, including my portfolio, I have a pretty large single family portfolio, my syndications have done better. Both the ones that I invest in and the ones that I passively invest in have beaten my own single family investments. Why? Because I'm not paying any professional level of attention, whereas I have 3 asset managers, 4 people in the development team that are asset managing existing properties and developing new ones, and they meet on a daily or weekly basis to manage those properties. So when you do something professionally, you actually do it better. So I encourage you as investors to actually go out and run this experiment. I would say 9 out of 10 of you will do better with your passive investments than with your actives. We just simply tend not to track that, especially because if they're not doing well, there's this desire to just kind of not track them because that's not going to make us feel good.